Hi. So, as you all know, the one big beautiful bill passed in 2025, and that enacted sweeping tax changes that really make many of the 2017 Tax Cuts and Jobs Act provisions permanent, but it also added new cuts and limitations. So, we're going to talk about some. It was a big, beautiful bill, so there's a lot in it, but we're going to kind of hit the high points on what we think impact it will be impacting your business and how you should be planning and thinking about your business for 2025 to be able to maximize some of the tax changes that are being enacted or restored. So, I mean, I think first and foremost, the 100% bonus depreciation. So, Scott, you want to talk a little bit about what that means?
Yeah, well, the 100% bonus depreciation is, of course, a big deal because it allows for immediate expensing. And in conjunction with that, there's also been enhancements to the Section 179 depreciation. What clients will want to be very mindful of there is you can drive NOL losses with the bonus depreciation. That may or may not be a good idea because NOL utilization it's not limited in terms of how long you can take it, but you can only use it to offset 80% of your income in a subsequent tax year. So you don't want to overshoot the runway and then wind up having more taxable income next year than you would have if you elected out of some of the bonus depreciation or some of the 179. So it really comes down to careful planning on the capex and a determination of where you're going to be. And for the pass-throughs, it's not just that you drive a loss in one company. It would be how much of that loss can offset your personal income and other business income. So it can be relatively involved if there's a number of entities.
Right. And so we need to be looking at all of those pictures to be able to have a comprehensive strategy about, purchasing big assets because we can really offset and carry that loss forward over time. Is there a cap on the
No,
amount? Okay,
no.
there's no
There's a
cap.
cap on the 179, but it's quite high. There's no cap on the bonus. And the other thing that's in there, kind of in the 100% bonus, is if you're investing in a new facility or a used facility, you can now write off long-lived capital assets that previously was unheard of. So you could basically buy a factory and write it off immediately. Um, so for larger companies, that may be a great benefit because obviously, if you buy a $5 million factory and you write off $5 million, but you're only making a couple 100,000 a year, it's going to take a while.
Yeah. And that really supports the manufacturing folks and the distribution folks who have those big asset potential buys. It also impacts real estate significantly, right?
Absolutely.
Um, and cost seg. So we can do cost segregation within a real estate or a build also.
Yeah, on the cost segregation, that'll be another area of analysis in the first couple of years because if you really can write off the entire building immediately, then a cost segregation isn't that going to be all that helpful. But if
Mm.
you decide that you really don't want to write it off immediately because you want to spread it out, then the cost segregation comes back into play.
Okay, gotcha. And we have to keep in mind this is federal, so depending on what state you're in, that your state taxes are a different strategy.
And that is absolutely an area that we like to focus in on when we have clients, especially clients that have huge differences between their California income and their federal. And that's mainly driven by differences in depreciation. And we've had clients, they have zero federal depreciation and they've got a ton of California and they really can't figure out why they have high federal income and low state income. So we try to help them walk through that. And it's also, the good side about planning is that you don't get unanticipated results. So people can see it coming.
Yeah, I mean, this is a really good strategy. I know with clients, particularly my clients that have huge fixed asset purchases, we plan this appropriately to be able to manage our tax advantages and or liabilities, both on the state and the federal side, because we have to model it out to make sure that we're getting the best bang for our buck.
Well, and absolutely. And also to the extent clients are using borrowed money to finance assets and they're getting an immediate write-off, they wind up in a situation where they've inadvertently might have kicked the can down the road and created almost a self-inflicted Ponzi scheme because then their federal income is higher in the out years, and they don't have any money because they got to pay back the loans. So we've seen that happen more than a few times, and it's really important that you don't just have this annual tax plan on some of this stuff. You really need to model that out 3 to 5 years.
Yeah, and so speaking about that, there is also an interest deduction change in the big beautiful bill. So interest expense planning, of course, goes along potentially with asset acquisitions, but just in general, business interest deductions are reverting back to be the 30% of the EBITDA formula. So that is a benefit to the business owner as well.
Yes,
So,
absolutely.
yeah. So again, when we're modeling these things out, we need to look at all of the pieces. The interest expense plus the accelerated or 100% depreciation. We need to look at it all at the same time.
Yes.
Um,
And
yeah.
one other thing that hasn't changed is the de minimis capital expenditure, $2,500 per item or 5,000 per item if you're audited. So, we usually encourage clients to take full advantage of that because it keeps it off your fixed asset list. And we also like them to have a separate general ledger so that they can know exactly what they're expensing and running it through. For a lot of our clients, we put that line below the EBITDA line because it's essentially the same economic concept as depreciation.
Yeah, it makes a lot of sense. And in this stage of the game, $2,500 is better to be expensed. Indeed.
Well, and you get I had a client, I think they bought 200 computers and they were all under $2,500. And so you could expense all of them because it's not in the aggregate, it's per item.
Right.
So a lot of people get very confused about that because they look at an invoice and the invoice is more than 2,500 and they assume they have to capitalize it and there's 3 items on the invoice.
Yeah, makes perfect sense. So moving that to the expense and not on the balance sheet is a good idea. And then having the right financial reporting so that we're tracking it appropriately and it's easy for us to report to our tax folks is also super helpful. Um,
Absolutely.
so let's talk a little bit about the small business exemption because growing businesses should generally be monitoring their revenue to their thresholds, right? So
Yes.
the threshold's pretty high, under 27 to 30 million in gross receipts. So, I mean, that's a pretty big small business, if you will.
Yeah, and then generally those are applied on a 3-year average. So
Okay.
so for businesses that are under that threshold, besides what's in the one big beautiful bill, some of the things that were in the Tax Cut Act was that they didn't have to necessarily use inventory accounting methods. They could just expense inventory. And they also didn't have to comply with uniform cost capitalization rules. So there's other things that are still tangentially in there that clients will want to take a look at and make sure
Okay.
that they're not overcomplicating their own tax returns because they really don't need to.
Okay. Excellent. And then we've got a lot of folks in the R&D space, and we were pretty concerned about the R&D credit, and that is now staying. So those folks, those businesses that were writing those R&D credits off can now elect to expense 100% of those qualifying domestic
Yes.
R&D expenses. So that's important for a lot of our clients because as a general rule, some of that includes payroll. And so we need to keep track of the portion of time that our scientists or our coders are spending in that R&D category because it's really important for us to be able to have an approach to filing our tax returns and keeping track of that expense.
Well, and absolutely, and clients will definitely want to understand the distinction between the R&D tax credit versus the R&D deduction. And so, under all conditions, I would say if you're working on any significant R&D, you're going to keep track of what you're doing anyway, so you have some idea what it costs you to do it. But if you want to take advantage of the R&D tax credit itself, you're going to have contemporaneous documentation um, because we have seen IRS audits on R&D tax credits, especially on amended tax returns. That just you can just assume if you're amending a tax return for that, you can expect a knock on the door. And if you don't have documentation, the answer is you're not going to get it.
Yeah, good point. And then there are also, because there was some change in the R&D and R&E tax credits, it looks like there's a special catch-up deduction in 2025 for the years of 2022 to 2024. So that is also very important for our clients that were backing off of those deductions to take a look and see if there's an opportunity for them to either, if it was capitalized, they can take that deduction or talk to their tax folks. So we can also help them model that and take a look at it.
Yeah, and it can get pretty complicated in a hurry because you have to weigh the deduction versus the potential to strand credits if you drive NOLs. So, and again, it depends on the magnitude of some of these issues. For a lot of clients, these will be, they're interesting, but they probably aren't impactful. But for guys spending a lot of money in R&D and or CapEx, these can generate a significant change in the net present value of your future cash flows for sure.
Right, right, right. So let's talk a little bit about the qualified business income. Um, and it goes hand in hand with the pass-through structures, right?
Yes. Yes. So on the QBI, that continues as is. So I guess the good news is nothing changed. Believe it or not, I have seen client returns where they don't take QBI. I've seen client returns where they're taking QBI on businesses that don't qualify. And sometimes it's like Goldilocks, they get it right. Um, so the important part of when you're taking QBI, especially if you have multiple companies, is it's company by company by company, because QBI is an element of your personal income tax return, not your business income tax return. Now we flip gears to the pass-through tax. The pass-through tax also remains unchanged, except to note that it's state by state, and not every state has a pass-through tax. California does. I'm pretty sure Illinois does. New York. And for the California residents, you taking the pass-through tax in those other states is fine because you're going to be able to take a pass-through tax on your California income on the end of these California incomes. So, apportioning it out of California, can reduce your pass-through tax, but at the end of the day, you're going to get taxed on your net California income anyway. Um, Seen plenty of cases where the pass-through tax has been something that has been misunderstood and people have just missed it. And it's a permanent difference to your federal income tax because the way it works is you pay the 9.3% on the entity's California income and you get that as a credit against your California income tax. Um, and then you get basically a permanent deduction outside of the SALT limitation. So it's astronomically important to
And the
make sure it's
salt limitation is remaining the same.
well, it's moved. The cap's moved to 40,000 on the
Okay,
income
so it's
side.
gone up.
It's
Okay.
gone up, and everybody's going yippee. But what they have to consider is that you still have to cross the floor of the standard deduction.
Ah,
So so unless you have a lot of property tax and a lot of mortgage, most people may still not get across that higher itemized deduction limit. So it can be beneficial. It's probably not as beneficial as you would think when you read it.
got it. Got to run the numbers. Again, it's
Absolutely,
all about the
absolutely.
planning.
Yeah.
Yeah. So, so while we're on this subject of California, it is also important for our folks to, if there's a possibility, to look at their income and what is California income and what may be non-California income. That can have a significant impact on a business owner's tax return. So folks that are doing business in other states should take a look at, it's very state by state again in terms of what the income rules are, but we in California pay the highest tax. So if there are revenues or income that can be attributed to other states, we should be looking at that. And I think a lot of our clients miss that as well.
Yeah, and again, that can get to be extremely complicated because one of the dangers, if you're supposed to be apportioning income to other states and you never file a return, and 7 years from now they call to knock on your door, the statute of limitations never started because you never filed a return, and then they'll hit you for the tax. You won't be able to go back and amend your California return to reflect that tax paid to other state because it'll be past that period of limitations. For most S corps, if you can allocate income to other states, it makes sense to do it for a lot of reasons, not just compliances, because you're going to lower that 1.5% California S tax. So if you've got a lot of income that goes to other states, you could drive the S tax down. All of the income is going to flow back to you as California income anyway, but it'll be net of income taxes paid to other states. And so since California, as you said, has the highest marginal rates, it's not like you're going to be paying tax on a state higher than California and kind of stranding some tax dollars. That just doesn't happen. But the compliance end, we just know, as we've seen from the sales tax side, which is even more complicated than income tax, is states are, they auger in, and the minute California decides they're going to take a look at something, and everybody else has to scramble because they need to equalize the game, or California is going to basically stick them with some of the California bill.
Right, right. So all of you folks, S corps, LLCs, partnerships, all of this relates to you. So again, planning is super important so that we can take the benefit of the bills as much as possible. Let's see. This is the QSBS. So this relates to a lot of our investors out there. We've got some private equity folks and some private investors that take advantage of QSBS and the gains on the sale of C Corp stock if it's been held for 5 years. So that actually changed in terms of the limit. So the limit went up to 15 million in gain on the sale of that stock. So that's good news. There's also now a 50% exclusion on the 3-year hold of the stock and a 75% exclusion on the 4-year hold. I know I've got a client who had staggering stock purchases, and so some of the stock they held for 5, and then some was 4, some was 3. So this is really going to benefit them. Some really small, tiny things is that the 1099 reporting threshold changed from $600 to $2,000, which is great administratively. It just makes a less of a burden on some of you small businesses who are filing those 1099s for $600. It's now moved up to $2,000. The special incentives probably doesn't impact a lot of the folks that we support, but there's some ag credits and some green energy credits that have been repealed or cut back. So those of you in those sectors, reach out to us directly, because that will also impact how you plan for your tax strategies. We talked a little bit about cost segregation. 1031. Let's see. That's hasn't changed, thankfully. So that is steady Eddie as you go. So with 1031, we still have the ability to do a like kind exchange for real property. And I know lots of our clients have 1031 exchanges either on their personal real estate and or some of their business real estate. So super important to know.
Of course, the one
Salt.
thing I want to make sure on that is I want to make sure that they're keeping track of what their deferred tax liability is, so that they don't wind up, having a heart attack when they finally liquidate.
And really, we recommend that if you're doing 1031 exchanges, that you use a professional who really knows what they're doing and can help you make sure that you are in compliance there.
Yep.
Do we need to talk any more about salt? I think we really addressed.
Yeah, I think it's, like I said, it's not nearly as big of a deal as it sounds when you hear about it on the news. But yes, it can be helpful.
So I think the key to takeaways for us and how we can help you and your business are several. One is we should be planning, multi-year planning, and manage our net operating loss versus our taxable income. We should be maximizing our net operating loss abilities for carry forwards. And we should be looking at our excess business losses in comparison to our net operating losses to really make sure that we are maximizing our ability to mitigate our tax. And then,
Well,
of course, state is totally different. So we need to do the analysis both on the federal side, and then we need to do the analysis on the state side, depending on where you're doing business.
and one thing that I think a lot of our clients um, are, I would say, can be confused by is they're generally doing their books on accrual or something close to accrual. They're generally following GAAP or something pretty close to GAAP. They're doing their tax returns on cash. They don't understand all the nuances of the differences, and even on a cash basis tax return, not everything is cash. So it's really important that clients get a read periodically of what's their taxable income actually look like compared to their book income and also their state income, because those differences in any one particular period of time can be huge, just absolutely positively huge.
Huge. And when we're making our quarterly payments, we should be going through that exercise because I know you all get your vouchers at the end of whenever you file your tax return, but we need to do those calcs to make sure that those vouchers are still applicable to the quarter.
Well, absolutely. And if clients are taking the safe harbor, which is what the vouchers are based off of, that's fine. But what they want to know is, okay, well, if my tax liability is going to be millions more than the vouchers, I'd like to know that at least. If it's going to be a lot less, I might prefer to use estimated. And then in California, if you're above a certain income level, you can't use the vouchers the CPA sends you anyway, because you have to basically go 90% of your current year estimated income. So again, it's not complicated if you keep up with it, but the time to plan is probably not November 15th, because that doesn't leave you a whole lot of runway. And what we like to say is if you plan to fail and succeed, we're not really sure what you accomplished.
Excellent point. Yeah, we definitely don't want people having $1 million tax surprises in November that we could have mitigated. Gosh, there's so much here. If you all need support or would like some time with us to help strategize on the big beautiful bill and the impact on your business and your strategy for being able to maximize your resources, please schedule some time with our CFOs, Scott being one of them. We really appreciate Scott stepping in and imparting his wisdom on us today. And definitely click that bottom button and schedule some time with us. Thank you.
Thank you.